Let's talk about mortgages today. I'm sure there's many people jumping back on the fence because the rates are as high as they are. And then you have those that are out in the market that are pursuing a mortgage. But let's talk about the types of mortgages that are out there. You have fixed, which means they're fixed for a certain set time. You have variable, where the rate is fixed and then varies depending on the anniversary date. And then you have reverse mortgages for those people that are 65 or older and want to take equity out of their home. The first type of mortgage is a fixed rate mortgage for 30 years, for 15 years, whatever is available. Now those rates are historically high right now, but they haven't been adjusted lower since September of last year in 2024. And the reason is that our Fed Chair Jerome Powell is a little concerned about the overall economy, the labor participation, and also most important is inflation. He's not comfortable lowering rates, even though the president wanted him to lower the rates already, but he again is not ready to make that commitment. So until that point in time comes, the rates right now are hovering between 6.85 and 7%, and the variable rates are 6.147. The USDA rates are 6.429, and the 15-year is the lowest, 5.703. But it all depends really on how large of a mortgage you want to get, because some people will put a very large down payment, maybe 30, 40, 50%. Others will put down a total of 20% with an 80% mortgage. So you have to find out what your comfort zone is. And inventory is at a 50-year low, so prices are still on the upswing, but not necessarily in double digits. Although year over year they went up over 10%. I don't see that happening the next year and the year after. I think increases will be minimal. And again, as long as the demand is as strong as it is, it can't cause prices to go down. Demand has to cease and be reduced in order for those prices to come down. But it's the interest rates that's causing most people to abandon the market and just sit back on the sidelines trying to figure out, should they jump in again? Should they wait till rates go lower? But as long as you're getting the tax deductions and you're also getting whatever appreciation occurs, could that be worse than paying rent every month and paying down your current landlord's mortgage, giving him all the benefits, giving him all the power to decide if he wants to renew or let your lease expire? These are things you have to come into play. Or you can leave the area totally, move upstate or out of state, and find a location where the rents are cheaper or the price of the home that you want to buy, whether it be a single family, multifamily, townhouse, condo, or co-op. But you have to look at the numbers. You got to crunch the numbers and see whether or not your principal, interest, taxes, and insurance, whether that's a comfortable amount that you can afford to pay. You also have to look at your job and your industry to see, is AI going to take over your industry over the next 5 or 6 years while you're in your home? You have to see what effect that might have on your ability to pay. But the most important thing is to see whether or not you're really ready to make that commitment to be able to purchase. Once you know that you have that commitment in mind, you have to set forth a plan to figure out what budget you have to go into the market and search for a home. The first step should be you need to go to a mortgage person. Get a pre-commitment, or more importantly, a commitment letter. That commitment letter will obligate the bank to a certain degree as to what they will be willing to give you in a mortgage, as long as you provide them the necessary paperwork up front, the tax returns. They will do a credit check on you. They will check your debt to income ratio. They want to make sure that your debt to income is not more than they feel comfortable with. You can get a mortgage up to a 60% debt to income, but you have to have very strong financials. I think most people need to be in the 30 percentile, maybe low 40s. But if you're planning to buy a co-op, you really need to be down in the 30 percentile debt to income. Condos doesn't make as much, importance, because once you have a commitment letter, it'll make the seller feel comfortable that you can move ahead, and condos don't have a board approval process. So that's something to keep in mind. Although co-ops are much less money than condos. Condos are more of an investment vehicle that eventually one day you might buy a single family house and keep that condo for rental income. Whereas a co-op, you have a limited, if not at all, availability to be able to rent. Plus there's co-op approval. They will check your income, credit, debt to income, all your assets. It's a little bit more intrusive, but that's the way to do it. So if you can't afford a single family and you can't afford a condo, then a co-op is the one that you want to go with. So that's important to keep that in mind. What else can I tell you? Now you also have, if you're over, I think it's 62, I think I said 65. If you're over 62 and you live in a home and you have enough equity, you can get a reverse mortgage, which you can take money out of that house. You don't have to make monthly payments. The only time payments are going to be due is when you either pass away, unfortunately, or if you decide to sell the house, then that reverse mortgage will be due. But you don't have to make payments. But if you don't make payments, the interest accrues, which keeps increasing the amount that you'll owe at the end. I think I've gone through pretty much a synopsis of what's involved. And if you need any help, you can always give me a call. Thank you very much, and you have a good day. This is Phil from Turnkey Real Estate, 516-647-4289. Thank you.